Now, the argument for putting your money into the S&P 500 has been made by some very smart people, including Warren Buffett.
The S&P 500 index fund is the one to use. That's the one I used in that bet I made for 10 years. It's the one I've told the trustee for my wife to put 90% of the funds I leave her into. The S&P 500 is, I don't know whether it's 80% of the market value of everything you can buy in this country.
So today, instead of giving you an opinion, I'm going to address this question by going through 53 years worth of actual data to show whether or not investing only in the S&P is a smart move, or whether it's putting your retirement in harm's way. And you make sure to watch towards the end because I'll explain why the stakes are higher in retirement and what you can do about it. Hey there, it's Alex, partner and financial advisor here at 1 Degree Advisors, and I'm here to help you gain confidence in your retirement. So is it really that simple? Put 100% of your money into the S&P 500, drink a pina colada on the beach, and call it a day? Well, let's see what the data says. First, let's look at the S&P 500 versus international stocks. I'm sure it's the main thing you want to know. Now again, this data has been pulled from a blog post by Nick Maggiulli, and I've linked to his original post in the description down below. And again, we're going through 53 years worth of data. For the average retiree, that should be longer than someone should expect to retire. Now, when the line is above the median dotted line, that means over a 10-year period, the S&P 500 has outperformed relative to international stocks. And when the line is below, that means the S&P 500 has underperformed relative to international stocks. And the simple way I like to think about this is, if I were given money and told I had to invest in the S&P or international stocks, which choice would be better? As an example, if you invested in 2010 and then looked at your returns 10 years later, in 2020, you'd find that the S&P 500 had outperformed international stocks. Now, in the last 10 years, US stocks have outperformed international by quite a big margin recently. But the reality is that the S&P only outperformed in 54% of all rolling 10-year periods in this 53-year period. That's a little bit better than a coin flip. The reason why the S&P 500 seems to be much better is due to what's known as recency bias. This is when people believe what has happened recently will continue into the future. And when we take a look at the performance of the S&P 500, we see amazing performance compared to international stocks. And our natural tendency is to think that, well, then that will just continue that way. Now, if we were to look at that same chart, but we were in the year 2013, you might argue the case that international is far superior to the S&P. Besides the tech bubble in the 2000s, which one could argue was just a fluke, from 1970 to 2013, international stocks over a 10-year rolling period are clearly superior a majority of the time. So in 2013, your recency bias might influence you to exclusively invest in international stocks. And although that would seem crazy now, could we be doing the same thing with the S&P 500 now? Now, I've heard people make the case that the S&P 500 has so many large companies that have a global presence. So in a way, you're already getting exposure to international markets. But the thing is, when you invest in foreign stock markets, you're essentially betting on the dominant sectors of those markets. For instance, like Norwegian stocks means you're betting on the energy sector, and South Korean stocks means you're betting on consumer electronics and manufacturing like Samsung. And the same principle applies to investing solely in US stocks. Even though the US market is diverse, putting 100% of your money into US stocks leans heavily toward the US technology sector. And currently, the US tech sector makes up 26% of the market with a market cap of around $14 trillion. This percentage significantly influences the overall sentiment of the US stock market, making major tech stocks so popular. So while investing in US tech companies has been successful in the past, you should consider if this is the exposure you want in your portfolio moving forward. And I don't have time to get into it in this video, but I could also show how the S&P compares to, let's say, small cap stocks or other parts of the global stock market. So which should you invest in, the S&P 500 or international stocks? Of course, my favorite is a little bit of both. But if you're like most people, you probably don't like the idea, or let's just say have the patience, of picking a static allocation. Because if you did, and you allocated a decent portion to international stocks, I mean, let's just say something like 50%, then your stocks would be currently lagging the S&P 500 by a good margin. I mean, potentially for a decade. So what do you do? If we look at that original chart comparing the S&P 500 to international stocks, one thing is clear. Relative outperformance tends to cluster together. In other words, it looks like there are clearly periods of time when the S&P outperforms and then when international stocks outperform. So maybe you're asking yourself, can you just time it and shift it from one to another? I think going 100% S&P or 100% international can be a bad idea, but I do think there are ways to capture those trends. If we take a look at this chart, it's showing 1-year rolling returns comparing the S&P to international stocks. Much different than the previous chart, which is a 10-year rolling period. This is much shorter. As you'll see, even over 1-year periods, there appear to be clear trends when the S&P outperforms and then when international outperforms. That's why for our clients, we implement what's known as a relative momentum strategy to take advantage of these trends, either slightly overweighting the S&P or international stocks. And it doesn't mean we're going all in or all out and it's all or nothing, and it's certainly not a silver bullet. There are periods of time when it doesn't work great. Again, check out the times there are spots of what we call whipsaws. It's when one outperforms for 1 year and then quickly reverts. You have to know what you're doing and be patient, but we've found using a strategy like this can help, especially when there are extended periods of outperformance by a given country. But even if you invest in the S&P and international stocks, are you still missing something? Remember that your investment plan is important so you have a wonderful retirement. One of the things we offer our viewers is a free retirement readiness report to see if you're on the right path to that wonderful retirement. You provide a few pieces of information and then I'll record a video going through the data. And then from there, if it makes sense to have my team take a look at your investments and retirement plan, we can always do that for you too. Now, the simple truth is we don't know what the next 10 years will look like. When you're growing and accumulating wealth, you can usually get away with not diversifying well as long as you're consistently putting money away and saving for the future. In fact, when you're saving for retirement and the stock market goes down, that can be a great opportunity to buy more stocks at lower prices. And this is what's known as dollar cost averaging. But when you're in retirement and taking income, the stakes are now higher. If you're taking income out when the market is falling, that can be a recipe for disaster. I mean, in effect, taking money out of investments that are declining is a bit like reverse dollar cost averaging, and that hurts. And in reality, diversifying between the S&P and international can provide benefits, but when markets decline, usually both are declining. I wouldn't expect to see, for example, the S&P down while international stocks are up, or even vice versa. So while you want to be well diversified in your stocks between both the S&P and international stocks, it can also be wise to diversify among other classes like bonds and cash when creating income in retirement. For example, during 2008 and 2009, the last thing you want to do is sell your stock investments. And if you're well diversified and have a strategic allocation to cash and bonds, you can create income from those assets, which, as you can see, held up quite well and actually gained value. This gives your stocks time to recover. I recently had a potential client come to meet our firm, and they asked one of my colleagues how they should invest their retirement nest egg. But before we could even answer that question, we needed to understand what amount of income they needed. For round number's sake, they had $3 million, and through our planning process, we agreed we needed to withdraw $132,000 per year from their nest egg. Well, if their portfolio was 100% stocks, even diversified among the S&P and international, any slight downturn in the market and they would have to sell their investments that are down in value. And they didn't like that, and that's something that we want to try and avoid as well. So we asked them a simple question: how many years would you like us to be able to create $132,000 of income without having to touch your growth investments like stocks if markets were down? After discussing with them, they said they felt comfortable if they had 4 years worth of income. So now, instead of letting investments drive their financial future, we put them in the driver's seat. And again, if we just look at that $3 million portfolio, knowing $132,000 times 4 years, again, on a $3 million portfolio, that's roughly 20%. So what we did is we carved out 20% of that portfolio and put it into a strategic allocation of cash and bonds. In this strategy, when markets are down, we use bonds and cash to create income, giving markets time to recover. And then when markets are up, we don't get greedy and we trim off some of that growth to replenish and replace those cash and bonds for when, not if, the market has another downturn. So is the S&P 500 all you need in retirement? And honestly, I'd argue no, especially if you're approaching or in retirement and you need to create systematic and reliable income. But you can get all these things right and you don't actually make it to retirement, then what's all this for? Many folks that have come to see us who aren't yet retired often suffer from what I call 1 year syndrome. And maybe you're ready to retire, but there's always something that comes up. So you think to yourself, next year is the year I retire, and then the cycle continues and you haven't actually made that plunge. And if that's you, then you'll want to watch this video where Anthony breaks down if working 1 more year actually matters. You can check that out right here. Once again, this is Alex Okugawa, partner and financial advisor here at 1 Degree Advisors. And if you're interested in learning how we help our clients gain confidence in their retirement, visit our website at www.onedegreeadvisors.com.